let's take a look at Riot. Back to Riot.
That's exactly what I was going to say. It's rallying as we speak.
New highs, new all-time highs as we speak. So extremely interesting chart. I kind of want to see if Bitcoin has made a new high off that as well. Looks like it has.
If Bitcoin
so they are still moving in lockstep, and I think Riot might be outpacing just a little bit based on our previous chart that we had up. This makes it a very difficult product to trade. What do you think, Anthony?
I think it's important that when we say that the congruence is out of whack, that it's not necessarily because of value. We're just looking at relative pricing. We're not saying anything is overbought or underbought, oversold or undersold. What we're kind of telling you guys is that we're just purely looking at the congruence between Riot and Bitcoin and how that's maybe, you know, the relative pricing of those. So we're not saying that one is overpriced over the other, because we don't know. Like, I think that's the thing with Riot, and I would like to look more into how much Bitcoin they hold, and because in how much they mine and how the business really works. Because if you know how that business works, maybe, I don't know, and I don't know this, maybe they're just highly leveraged in Bitcoin, so that when Bitcoin goes up by a certain amount, that one kind of goes up at an exponential amount because of, you know, the different types of leverage. And so again, with something like this, in a trade like this, because we're probably going to put on, like, you know, an example trade, better know your product, better know what you're doing.
Yeah, and Anthony makes a great point. These two products are linked. They are inextricably linked. You can't, that's definitely the case. But I'm just kind of expanding on his thing. This is a business, right? This is, you're talking about Bitcoin, which is a product, and you're talking about a business, which is taking advantage of pricing that product. Where do we see this all the time? We see it in crude or a lot of different commodities, right? Once you're taking that product, if the price of the product goes up, chances are you might be making more money of revenue because you're taking a percentage over that. But what if your costs increase as price goes up? What if you are leveraged in that product, so you only get a piece of every move up, or you could extend your piece, the amount that you gain in a move up. So you have to know the company as well as the product, right? There's a lot of inputs. This is an entity, right, that has expenses, that has people, that has human error, that is all those kinds of things that you have to take into account when trading. You're no longer trading the product. You're now trading the company that depends on that product, and it's very important to make that distinction.
Yeah, I agree. And stay risk defined.
Yeah, absolutely. So, okay, I mean, this thing's blowing up as we speak. We've got 250% implied volatility. That's given us a 1292 implied move in the next 2 days. Okay, that's almost a 20% move that we're looking at based on, I mean, we're seeing 22% today. I don't see how that should be surprising. But that's implying a 22% move. The ball in this, as you expect, we're looking at the 90, which I think is our top strike. I've only got 80 strikes on here, but we'll put 100 in there just to be sure. 80 and 90 is our top strike. We've got a $1.90 bid in the top strike in the chain, which obviously might move up soon. But what are you seeing here, Anthony? I'd like kind of a way to take advantage of this implied volatility, but I don't know that. My first thought is Iron Condor, but I'll bet the Iron Condor credits are going to be minuscule because the vol is so high all out through the wings. What are you thinking?
Yeah, and I'm almost like looking like, do we put something on for this week or next? Look at the straddle for next week. You know, I'm thinking like maybe go into that one because we're getting so much more for it. Yeah, we're going to have to bite our fingers for a little longer. But like that's a really expensive straddle. I mean, look at that. That's what, let's see, the 70, we'll call it 75. What is a $25 straddle? So your break evens, if you sold it, that's if you did, break even at 50 and at 100 on the top. So I'm thinking maybe find some way out of the money options that maybe like you said, a really wide Iron Condor for next week.
Yeah, I mean that straddle. Here's how I think about it. We're getting a $14 move today. Let's say that that's a really big move for what we're going to see over the next 9 days till expiration. let's cut it in half. That's a $7 move. 7 times how many trading days do we have in that time frame? We have 7 times 7. That's $49. I mean, that's a long way. That is a long.
You know what the problem is too, Bill? Is look at it only goes up to the 90 strike.
Exactly.
And I might
this is something where I might, I wish this is where, that's what you're going to see all the time. When you get a 25% move up, you can almost guarantee that your topside strikes won't be ready and prepared, unless it's something like Boeing that had those listed and was trading $400 last year. This is something where if I'm thinking, trying to give myself breathing room on an iron condor, something that's moved $15 has a regular kind of MO at this point of moving 10-20% in a day, I'm probably looking to do something in an iron condor about 50% away, and that puts us in the 110 area. We just don't have that strike. So what do we do? Maybe a ratio?
I was just thinking that. Will you do like 2 put spreads versus 1 call spread kind of ratio? It's going to have like a bullish twang to it because you're selling more put spreads, but maybe you're just, I'm thinking about selling less on the upside because it's closer and trying to capture the premium on the downside so we can go farther away. You know what I'm saying?
Yeah, I like that idea, except for the fact that I think all the momentum in this is to the upside. Obviously.
Yeah. So you think that we just won't get the premium on the downside? It's possible.
I think it is possible. All right. Well, what do you? I was thinking more. Well, before you do that, I was thinking more of like a 1x3x2 or something, like some sort of butterfly, where if it runs through it on the upside, we're still making money. But if it doesn't get all the way there or dies somewhere in the middle of that spread, we can still take it off for a profit, hopefully. You know what I mean?
Yeah.
Well, what if we did both? What if we did an upside call spread for around a small credit or for a small debit and then funded with a downside put spread?
So you want to buy a call spread and then sell a put spread?
I want to buy a call ratio. So this is going to be a pretty complex trade if we do it, but buy a call ratio and then sell put spread to fund it.
So you like a 2-to-1?
Like a 1x3x2 or something.
Oh, you see, like maybe like selling a put vertical, like fund like a call tree almost.
Yeah, yes, or like a call butterfly, an off balance call butterfly.
Yeah. No, I'm good with that.
Let me try this. All right, bear with me. This is going to be a silly trade to start out with because I'm just messing with the numbers. But I've got the 175, and then oh shoot, I wanted to sell that 175. Sell the 185 3 times. That's a $14 credit. Then we go out to the. How tight can I make this? There's only 80 cents difference between the 90 and the 87. From a midpoint factor, that's kind of a lot.
Are you doing next week's or this week's, Bill? Next week's?
I'm doing next week's.
Okay.
This is a $1.50 debit. And I kind of want to analyze this real quick to make sure my mental math is working. We're paying $1.50 for a $10 minus 2 of the 6. So we'd still walk away with what, $250? $350? If we did this, if it went over it.
What's a realistic price that we get filled? What's the natural saying? Sorry, the screen's too small.
Not what?
Does that say 4?
No, really, it could be. Yeah, 375.
Yeah, that's a wide.
Realistic price. Let's see. So if let's take a look at the spread. I mean, if we're doing the whole thing, it's 65 cent debit. 65 cent credit at 305. That puts our midpoint at 128. I mean, I think each one we'd have to pay past the midpoint, and we've got 6 different legs in this. I mean, I think you'd probably have to pay $2 in real life, $2.25 even to get filled in real life. That's my guess. Obviously, I have no leg to stand on with that guess in real life because you won't know until you enter it. But
yeah. So to let everybody know,
Oh man. All right. Well, let's get this on.
let's-
MJ2 Light wants to look at pod stocks, which I
Yeah.
kind of do.
Yeah.
Let's. I mean, so let's just do this, and then we can fund it with a put spread. What are you thinking? What are you thinking on the put side, Anthony? I'm gonna put this in for a $2 debit. I'm just doing one of these, by the way.
Yeah. Yeah. I'm looking at credit spreads right now. I mean, if you do one.
This is. Keep in mind. I'm Feb 26. I'm a week out.
Yeah, me too. Look at the Feb 55.50 put spread. That's $1.30. What did you end up paying for that?
I paid it $2. I assume I got filled at 79 cents. I mean, that's a paper money fill. I think you'd have to pay more than that.
We have to price adjust that one. Man, you know, it's we're gonna have to kind of come closer to the money to get, you know, any decent. I don't know. Take a look at the 55.50.
The 55.50, I think, is a nice. It's a nice distance away. That's like a 33% move away, pretty much. That's a lot to go. That's more than one day. So you'd have to, even on a day like today, it's more than one day. So you'd have some time to react and start to run into it. You get $1.30 credit. I think even you might get filled in real life at even like $1.25 here on this thing. I don't hate it. I don't hate it. It's a good amount of weight. You're getting almost a 4-to-1 there.
Yep, do it.
All right, you want to do multiple of these? Maybe like 3 or 4?
Thank you, MJ2 Light. Man, we can't get enough of you every Wednesday. So.
Oh yeah, much appreciated. All right, well, I'm going to take this down to 125 because I think that's a little bit more of a realistic fill. That might even be a little generous. But, oh, we got 127 in paper money. Wow, just really swinging it out the park. So I think this is a pretty interesting strategy. And I want to go back and real quick before we move on to pot stocks briefly. This is the call tree that I built, right? Oh, this is got the puts in there now too. But I want to take these out. This is so you paid $1.50 for this. This is going to get updated with the price that we got. I mean, I think we got paid 79 on this, but so you have your max loss at the bottom, and then if it busts through all that, you've got this long call spread with all this room for it to be profitable. Now, what's tricky about these, if it runs up to $86, $85 tomorrow, this is probably going to show a loss on here. This is a little bit of an expiration play when you do these ratios. Because you've got one that's all the way in the money, but then you're butting up against 3 of them that you've lost a lot of money on now. So you might even show a loss. It's really more of an expiration play than anything else. And as you can see with the purple line, it doesn't really move very much. That's really something that's going to be more affected by time than anything else as I move the ticker forward here. Okay, well that was just my little 2-piece on that. I think that's going to be an interesting trade and something to watch. Hey everybody, thanks for watching. We post new videos every Wednesday, so to stay up to date on new videos, please subscribe. And don't forget to hit the bell to get notified about new uploads. Be sure to follow us on all your favorite social media platforms and open a TD Ameritrade account by clicking on the link in this window. Thanks.